Thank you, and good morning, everyone. Thank you for having us. Great. I've been asked to moderate this session, and I hope we'll do justice to the topic. I believe actually we'll do justice to the topic, given the people around me here. I've got all the confidence in them to do the best to the topic. And just to kick off, Robert, let me start off with yourself, since you just joined the panel. The others had an opportunity to present, and maybe just to kick off, just in generally, generally speaking, maybe just highlight some key risks current that the retirement fund industry has been facing, and potentially one or two emerging ones that you're seeing that the industry is facing.
Yeah, so I think to start off, Thierry did mention this global inflation trend that we are seeing. I think that's definitely something worth keeping an eye on. Obviously, if we move into a high inflation environment, that does sort of reduce the purchasing power, not only of those who are currently earning a salary, but those who are relying on their savings in the longer term once they retire as well. So I think that's something emerging to keep quite a close eye on. I think more Namibia specific, something that's really concerning to a large extent is how we've seen the exposure for Namibian pension funds in particular has increased relative to the exposure of holdings in Namibia. We've seen the reduction in the exposure to dual listeds from about 2013-14 onwards down to 10%. In addition to that, we've then seen the increase in the domestic asset allocation requirement from 35 to 45% from about 2018 onwards. And this has also coincided at a time when the Namibian economy has slowed down quite dramatically. We've seen very little growth, if any, from about 2015-16 onwards. Obviously, that large contraction last year, given the pandemic and the slowdown caused by the response there to a large extent. And then we're moving forward looking at relatively low growth environment. So that is really a major risk. We're seeing an increase in concentration of pension fund holdings directed towards Namibia, but the question is that really then the best environment given the limited investable universe as well as the macroeconomic environment that we're exposed to on that front. And then I think another one which we also like to keep a close eye on is the size of government's budget deficits, current and looking ahead, as well as how government plans to fund these to a large extent. And given the reliance on domestic funding, we tend to see that most of that funding comes from our pension funds. And the question is that really the best way? Is it in the members' interest as well to see a lot of pension fund money flowing towards funding budget deficits?
Thanks, Robert. I just urge all of us as we identify the risks as well to keep in mind that we're in a retirement fund industry where trustees have got an enormous responsibility to actually ensure that the ultimate beneficiaries retire with dignity, and therefore I urge all of us to just provide some solution to the risks that we identify or venture to try and find those solutions. If I may then just move on quickly to Thierry. You spoke in your presentation around the risks of inflation. Can you just really unpack that for us, what it really means for savers? What does it really mean, the risk of returns that are below inflation? In other words, negative real return. What could that mean really practically?
Thanks very much for the question, Ino. So, whenever we look at investments or savings, often at times, even money, paper money is just barter. In other words, it's something that allows you to get what you want. If you want to buy these flowers or if you want to buy a chair or whatever it might be. And obviously we know the price of goods and the cost of living increases. And so when we talk about inflation, we just talk about the risks that, if you put $100 Namibian in an investment today, and you could afford to buy, let's say, this chair in the audience cost $100, and in 10 years' time, that chair costs $100, amount of money you have is more, what you can do with it is less. So that's really what we're talking about. You want to be able to grow your investments so that you can not only buy one chair, but you can buy two chairs rather. And so that's sort of the risks we talk about. So I just used a simple illustration, but obviously in our context, we're talking about retirement funds, and we want people to be able to retire with dignity. And in order to do that, you need to have a real return on your investments over a very long period of time that allows you to then retire with the financial dignity that we're talking about.
Thank you. I'll get back to you on the later on the actual solution of how do we actually get those real return going forward. What should these trustees do to ensure that their funds are able to generate those kind of returns? Stephen, let me move across to you. In your presentation, you spoke about the ESG, and one of the points that you focused on was the E, and which is rightly so. It's very topical. And we have seen over the years some asset owners putting pressure perhaps to the capital allocators and making decisions to actually exclude what they may consider to be sinners or big emitters and so forth. What are your views on such actions, and what ought to be done in that respect?
Thanks, Adam. Yeah, so that essentially refers to the negative screening point that I made earlier. So the main issue in South Africa and Namibia is first and foremost that we have a very small universe. So if you start screening out stocks, tobacco stocks, gambling stocks, alcohol producers, emitters, you're essentially left with maybe the retailers and the banks. So you're not left with much to invest in. The second point I would make is that removing something from your portfolio does not necessarily make the world a better place. By way of example, CalPERS, which is the Californian Public Employees Retirement Scheme, they banned tobacco investments. So over the past few years, they've actually lost about $3 billion, I believe, in returns through this negative screen. And now you have to ask yourself, well, did they at least get something in return? Are fewer people smoking now? Are tobacco companies still making cigarettes? So that's an example of sort of a negative screen really not achieving anything, and the retirement fund members actually being worse off. We feel the same about divestment, actually. So we don't believe in divesting, which is selling out of, say, high emitters, as you mentioned. We would rather stay invested, encourage the company to improve, and then hold management accountable. If you just sell the stock, somebody else buys it, and that purchaser might be a less responsible investor. And we've seen this in the US with shale oil, all the big oil majors sort of selling their shale oil operations to private equity, and these people just pump out oil and they have no regard for pollution. So it's actually better if those assets stay with Shell or BP, where there are investors such as 91 and Alan Gray who can hold these businesses accountable.
Thank you. So you are actually arguing for just transition, especially from an environment point of view.
Definitely.
Okay, moving on. Let's just make this a bit practical, and I want, and I'm a pledge to all of it, to the audience out there, for us to do justice. And I'm hoping you will. And I want to be practical again. I think it was one of the previous presenters, and I guess also Thierry touched on it a little bit. This point of people not saving enough, and being one of the factors that potentially lead to poor outcome long term. Robert, I want to come to you with regard to Namibia in particular. Especially for the contractual savers, we are to a large extent limited to what is allowed to be deducted from your income for these purposes for saving, which is currently limited at 40,000. I would imagine this is an inhibitor to some extent. And really the question to you is, what ought to be done here? And what, in your view, should be done to actually help solve part of that equation in as far as saving is concerned in a medium?
Yeah, so thanks for that. In my mind, there are essentially two parts to this. The first is creating the right incentives for people to save, and the second then is a bit broader, that's providing enough people with the opportunity to save as well. So on the first one, I mean, we've seen that deductibility has been limited to 40,000 per annum in Namibia for many, many years. The equivalent in South Africa is materially higher. It's up to 27.5% of your income, or 350,000 rand per annum, whichever is you reach first. And so I think that's the right incentive. You're encouraging people to put away that money because they can recognize that tax benefit now. It doesn't mean that they don't pay tax on income. Obviously, once they then draw down and when they retire, they are still going to be paying tax. So it's not that you're foregoing that tax, you're just foregoing it for a period. And then you can get that back later. So the question is, are we creating the right incentives? Is putting away 40,000 per annum sufficient for people to live off once they do retire? And I think, depending on your standard of living, for many people that might not be the case, especially given sometimes it's not good. Some years you don't get great returns, sometimes you do better. So I think the first move is to create that right incentive, encourage more people to recognize that tax benefit now and increase the limit. We've seen it was mentioned a couple of times in various budget speeches, increasing that limit now to 150,000 per annum, and that is encouraging, although we still have to see that being implemented. And frankly, we've seen that taking very long to be pulled through, although we do seem to have commitments for that coming in the next tax year or so. On the other side, I think, if I look at the employment statistics we have available for Namibia, there aren't really that many people who can even capitalize on that 40,000 per annum benefit, let alone whether it gets increased to 150,000 or not. And for a lot of those savers who are able to put away 40,000 per annum, recognizing the tax benefit of increasing it to say 150 isn't really the driver for them to save. And so the question is can we get more people then to be able to save money for their retirement, leave them less reliant on the state or family, for instance, once they do retire, and then that then comes through to a much broader conversation on driving economic growth and employment, which allows people to see real wages, particularly for the youth. We look at youth unemployment in Namibia from the 2018 Labour Force Survey, which is unfortunately the most recent data we have. If you look at ages, I think it's 16 to about 25, the unemployment rate there was around 60%. If you move the age bracket there from about 16 or 18 to 35, it's a bit lower, it's just under 50%. And so there's a lot of young people now who don't have an income and aren't able to put away any money for, say, the first 10, 15, 20 years of their lives, which leaves them obviously with a much shorter time span to put away any money should they retire one day. And so the conversation then needs to be, how do we turn Namibia from this environment where many of us are forecasting growth of maybe around 3% over the medium term to a high growth environment where we see lots of employment being driven and largely by the private sector.
Thanks, Robert. I think one of the points you highlighted there is that potentially people are now starting to, those that are fortunate enough to have employment are unfortunately getting employed at a much older age, which puts another challenge to the trustees, unfortunately, and perhaps a lot of other things need to be looked at in that respect. I think that's one point that I'm taking away from you there. Just moving on quickly to Ellie, I think one of the major developments in this country this year, and of course this development has been coming on for many years, has been the promulgation of what I refer to as FIMA, the Financial Intermediaries and Markets Act. And recently, the engagements with the regulator has been that they look to put FIMA in operation on the 1st of October next year. So naturally, that means that it's a change of the environment. I just want you to highlight to the audience and to the trustees and obviously to all the other stakeholders out there some of the risks, if there are any, and and of course, I want to believe there might be some opportunities in how trustees and the funds should be able to take um, um, benefit of those opportunities.
Thanks very much, Ino. So I think we've seen through the conference that the FEMA Act is definitely something very topical, and definitely we haven't sort of dotted all our I's and crossed all our dots there. But generally, I think one of the key risks, and I think was highlighted already earlier, was particularly on the trustees, is the fiduciary risk. So we know that the penalties sort of are becoming a bit are more severe, sort of in the act, and I think one way to potentially mitigate that is through training. So I think this has been mentioned before, and I think it would be sort of good for the regulator to potentially try and do more to get trustees training. One of the trustees I chatted to in the conference said, perhaps one of the potential solutions could be, we pay quite a lot of levies. So perhaps create an incentive where you take a percentage of the levy and we put it towards training, and we actually try and equip our trustees, so that they're not sort of, just caught, not knowing something. And I think as the industry and even as a regulator, I think we want a stable, financial system, and I think we want our trustees to be trained. So I think that's definitely one of the things that we can definitely do. And I think just in terms of collaboration, between the industry and the regulator, I think it can never be said enough. More is always better than less. So I think there've already been a lot of discussions that have happened, but I think more can potentially be done in just understanding some of the practical, implementation of the regulation. So I think we all understand the spirit of what they're trying to do, and I think we agree that it's the right way to look at it on a risk-based perspective. But I do think that from those working in the industry, sometimes the practicalities don't necessarily work out, and I think when you're dealing with a regulation that could penalize you for something that might not even be practical to do, I think makes it difficult. And policy certainty is definitely something that helps the industry. And not that we fear that the regulators is going to do something to us if we say anything, but it's just more when it's clear, it's just easier to put in a process, and it's easier for everyone to sort of be on the same page versus saying this is what you should have known this, that it was a risk. But as we know what the risk, it's like COVID. When COVID came, that's an event no one foresaw, but those kind of situations happen, and in those instances, sort of who bears the risks, and so I think those are sort of my comments on that.
Thank you. Audible. Okay. Bernard, sorry, yes. just maybe changing the gear a little bit. The bulk of the audience here are the owners of capital that most of you manage, or most of us do manage. And one of the things that you spoke earlier on with regard to ESG is how the ESG investment have grown over the years. You put up a chart there, and it was really, and the expectation for that growth, the capital that is sort of ESG capital. And I want you to sort of give the audience a bit of your understanding of how we should really be approaching environmental and social and governance issues, what to do and what to avoid doing in as far as ESGs are concerned, just to ensure that we get a just outcome at the end of the day. Do you mind just sharing your views on that?
Sure. I think you might ask, well, why should a retirement fund trustee worry about ESG at all? And well, I guess the first point I would make is that you might be compelled to do so by regulation. think about and incorporate these risks into my investment portfolio. Because your exposure to these risks affects the risk-return profile of the fund, and simplistically, how much money members will have in the end if you're overexposed to risks that you're not hedged against properly, for example. And lastly, I would encourage members to do it from an ethical point of view as well. I think it's just the right thing to do. We need to try and find a way to deploy savings so that we can marry the objective of sort of attaining high long-term returns for our clients, or in your case for fund members, without destroying the planet in the process. A previous speaker mentioned the balance needs to be found, and I agree with that.
Thanks, Stephen. I think we're doing well on time. In my understanding, we still got potentially 30 minutes. I got a few more questions for you, and then I'll open it up to the audience for any questions. Maybe let me just perhaps move to again back to Robert. In your previous intervention, you also spoke of the budget deficit that the country has been running for some time now, and the impact potential it has on pension fund savings, I guess, given the structural challenges that we have in our economy. Could you just unpack that a little bit, what it could mean? But again, as I urged earlier, what is to be done? If that is a risk, if there is a risk somewhere, what is the best way to navigate through those risks in order to ensure that the owners of capital ultimately achieve the best outcome given the constraints, if there are constraints there are.
So on that note, I mean, Tieni had the slide earlier of the investable universe for Namibia. So where 45% of those assets, if you take out the 10% of your listed, then the 35% needs to be invested. And I mean, it is frankly relatively small. The largest part of that is made up in government bonds, so government debt. What we've seen in the last couple of years is we've seen relatively large budget deficits being run, and we've seen a clear preference for funding those deficits from domestic debt as opposed to foreign debt, and for various reasons. The risk of repaying that debt, arguably the pricing on that debt as well might be more attractive for government. The difficulty comes where there are still large budget deficits going forward. Most, if not all, of the pension funds should at least be compliant with that 45% domestic asset requirement. And the question then comes running forward, with these large budget deficits that we are still looking to largely fund domestically, will there be sufficient demand from the domestic market for all of that debt? The question then becomes, if that isn't the case, how does government react? Do we see a change in the domestic asset requirement? Often we do hear changes to something like that couched in very broad terms, things like deepening the financial sector, sort of growing the, it's there to grow the economy and so on. And while it might be couched in those terms, I think especially where there's a fiduciary duty, the big question to ask is, how does that impact the money that we're effectively supposed to look after, the interests of our members? Because at the end of the day, that money belongs to those individuals now and when they retire. And is that going to be driving the best returns for them? And where we do see change to regulation, the de facto impact is that we do see most of that money flooding into government debt and thereby helping to fund the deficit, simply because there isn't much else available in our investable universe. And so that is simply the fact of the matter. Where we do see that increased demand coming in, that obviously has an effect on pricing, and then again, as that demand dries up, it again affects pricing, the returns that members may see at the end of the day, and that the fund managers will have to deal with as well. And so the question is that always the best strategy? I think obviously our focus, and this is sort of a broader thing again, is driving sort of growth reforms domestically that don't require large budget deficits with reliance on sort of fiscal consolidation, allowing inflation to take care more people spending money, that does better for companies and companies improving their tax contributions as well as larger VAT collections as well. And then also on the expenditure front, reforms to see really, are we spending the money as best as we can? Are we seeing sort of the best efficiency of that spend on projects and areas where we're seeing a larger economic benefit, yes or no, or is it largely consumptive expenditure?
Thanks, Robert. I think to now let me just come to you quickly now. I think investment, as we all know, I think it's complex, and we appreciate it. And trustees really, I guess, appreciate it. But at the end of the day, we're highlighting all these risks from ESG, from potentially some emanating from regulations, and just simply the environment in which we all are operating in. Bring it all together and say, yes, accept there are those risks, but nevertheless, the pensioner, the saver now today should still retire in dignity. That's why you guys get paid the kind of money you pay. How do you ensure, what view would you have to ensure that, would you give actually to ensure that trustees, through retirees and savers through trustees take the best decisions to actually ensure dignified retirement, whereby the returns are real over many, many years, notwithstanding all the challenges that we're highlighting, be it local, be it anywhere else.
Yeah, thanks for that, I know, and also highlighting that we don't sleep a lot. We try to make sure that your money is best invested as possible. But yeah, no, just to highlight, even with the local restrictions, we're still fortunate in that, there's the rest of the portfolio. So there's the 10% due listed, which we can, use for some of the due listed companies, which have a different risk profile from the local assets. And even within the local assets, we've seen an increase in issuance in inflation-linked bonds. So we talked about inflation risks, and inflation-linked bonds do actually give you some protection sort of against inflation. So maybe not credit risk, the risk of default, but definitely inflation risk. So that's another asset locally that gives you a different risk profile. So the 10% I mentioned, but we've also got the offshore exposure, and most asset managers, if you'll see, they do have exposures to sort of different countries, different regimes, and different sort of types of companies. So we do diversify the risk, and it is quite a sizable part of most of the industry's sort of assets. So maybe just to highlight, for example, inflation. So I chatted quite a lot about it, and some trustees might ask, so what are we doing in the portfolio if we've got such a high, maybe tilts towards cash and Namibian government bonds, because it's very hard to put it elsewhere. So we try and balance those risks with the other parts of the portfolios. So for example, Stefan mentioned, some of the share, Glencore, which is a share that we quite, that we like, but the good thing about Glencore is it's a commodity producer, and commodities typically do quite well when you're in a very high inflationary environment. Similarly, in our funds, we also hold some ETFs and ETNs that are linked, for example, to the price of platinum, and we also own a couple of the platinum shares. And so we sort of look for opportunities sort of elsewhere in the portfolio, just to ensure that the risks, we're not taking concentrated risks. And then the last one to highlight, we hold sort of very little, for example, in sovereign, we've got little fixed income in the offshore component of the portfolio, because we really have locally a high sort of exposure, so we've got very little, but also there's very little yield out there in the world, particularly in the developed markets, with negative real yields. So that's sort of just to highlight that it's not all doom and gloom. We are managing it, and we do think there's some great opportunities. But I think if the requirement does continue to increase, I think definitely it does sort of restrict the ability to get a different risk sort of profile.
Thank you. What I'm hearing from you is that notwithstanding these risks that you highlight, all of us, or all of you have been highlighting, there are still would hopefully result in very good outcome for the savers. We've got about 24 or 5 minutes before we end of the session. I've still got a few questions, but perhaps just at this juncture, there might be questions from the audience, and I just want to open it up to the audience. Unfortunately, the light is shining on my face. I can't see all of you. So if anyone can just help us see if there are questions from the audience. Stefan, perhaps just one last question from me to you is maybe just having listened to your fellow panelists and also what you've been saying yourself, what would be some of the one or two points really that you want the audience to take away from this session, from your point of view? It is far obviously the topic is concerned.
I think it's sort of a golden thread through this whole discussion, and that is the importance of carefully thinking about risk and to think about it broadly and to think about your blind spots. To not only think about sort of what are my investment returns going to be, what's my member behavior like, but to also think about the things in the periphery, such as some of the ESG risks that I tried to highlight. And then to ask yourself whether those are properly accounted for. I think that's my take.
Thank you. Robert, what are some of the, from your point of view, I mean, Stefan is saying, look, think broadly, think about your blind spots, those we all do, have those, and ensure that you actually put a proper structure around the fund to get those outcomes that you desire, that are designed for the fund. What would be your key takeaways that you want to leave, the key message that you want to leave the audience with as far as managing capital in these very volatile times? And there will always be volatile, unfortunately. There will always be issues, many issues, could it be regulatory, whatever they might be, but that's life. What would you want to leave them with?
I think the first one of two is obviously that we're looking, or they're effectively looking after the money of other people. And so often, I mean, I'm not very great at managing my own money, let alone that of other people, but often when we don't have that direct interest in it, we're not always as cognizant of all of the risks and other considerations that need to be taken into account. So I think the important thing to remember is that this isn't some abstract term, the savings pool or pension fund savings. This is sort of the lifeblood for many people one day. That is the first. I think the second one is to interrogate things very, very deeply. Whether we see proposed changes in policy or regulations or anything similar, it's not worthwhile taking it at face value or reading, say, the forward and saying, all right, well, this is what it intends to do, it must achieve that. I think it's important to interrogate that and think through the consequences, both intended and unintended, and what those may have for the people whose money we're here to speak about today. I think that's sort of the key take-homes from my side.
Thank you, Robert. Interrogate things thoroughly. What should they interrogate about FEMA?
Yeah, I don't think I've got much more sort of insight just in terms of what more to interrogate. But I think my point I mentioned earlier, just in terms of I think collaborating and actually, us, understanding the regulator and where they're coming from, and then also understanding sort of where we're coming from. I think definitely, we can do things constructively because ultimately, as we mentioned earlier, we're all looking at, a system that's robust, that's actually going to achieve the ultimate goal of allowing people to retire with financial dignity. And earlier I put a slide on the Global Pension Funds Index, and I think our country is actually, as much as the challenge we've highlighted, we still live in a country that's stable politically. We've got very sound financial institutions. We've got laws that apply, and I don't think that's the case for So we're coming off a good base. And I think, yeah, we should interrogate each other and make it better. And I think sometimes those are difficult conversations, and that's what we are having. But I think that's sort of something that I just want to leave, that actually we're in a good position and we're trying to get in the best position. And I guess that's hard sometimes, but definitely I think we can achieve it if all the stakeholders sort of come to the fore.
This is the biggest thing that I gone because I see my colleague is training to hear myself. Probably not used to not hearing me. I know. Too well speaking.
Okay, I can't see you again. Okay, now I can see you. Now I can see you.
Okay. If I stand up, I'll be cutting off other people.
No, it'll be too tall for everyone.
Yeah.
Please sit down.
Yeah. So thank you guys. I think it's really a good kickoff and a good discussion that we've had. I have one question or one issue. Maybe I should call it an issue. If I say it's a question, people don't want to talk about it. Let's say it's an issue. We mentioned from morning time net replacement ratio and all of that. But what I have found being from the pension fund, the employer's pension fund, let's call it that, that sometimes the principal or the initiator of the pension fund is not really having too much interest in what that net replacement ratio signifies. But we've come to experience is that while you work for the company, you get medical aid and you contribute to your pension, all of the above. Then you reach retirement. Now, if you're going back to the reservation, to the village, it's probably not a big issue when you come to medical care because then you'll go to government clinic, you pay your $20 and you get your medication, your chronic medication, whatever. And a lot of us are now having, with the workplace being project driven, most activities is project driven. So most people do not realize the impact of a project driven, a delivery driven output system on your body, on your mind. So all of these things catch up with you as you enter retirement. That means you have a hefty medical bill after retirement. Now, in the olden days, especially the status they were very well treated. They had post-retirement benefits. So your post-retirement medical aid, so still no contribution. So no problems. They could contribute productivity till they reach retirement. Nowadays, there's no post-retirement anything for you. And the cost of the medical aid post-retirement, if it's for a husband and a wife, it is easily 16% of that 75% net replacement ratio that you have there. So that means you're already sitting on 60%. So what is or what should be done to ensure that post-retirement effects is lessened? One of it from my side would be to ensure that the regulator is not here today. He might not like me after these 2 days, but the regulator may need to introduce a minimum of contributions to any retirement fund to ensure that when you reach retirement, that at least that heavy hit that you will get on medical aid is softened. That's my opinion, that's my suggestion. But you four smart guys out there, I need you to help me so that we can get to some solution. Should Arthur, as a pension fund spokesperson, representative, is there something that you guys think that Arthur should be doing on behalf of all of us to lobby or to entice or engage with the regulator and the government on minimum prescribed What do you guys
Thank you, Doga. I will venture to answer part of your question with the following caveat. I'm not an expert on benefit structure and all that, but I also hand it over to the experts who are much more qualified than I might be. Firstly, I think some of the challenges that we are meeting here today under the auspice of reference. It's a body that ought to be, in my understanding, that is there for the benefit of its members, who are ultimately the men and women that are working and contributing to these pension funds, that you should speak with a single voice on matters of mutual interest and mutual concerns. And I think you should, where issues like these do come up, it's important that they're taken on and researched further, be it through reference on other institutions like NASIA or others, and ensure that a sound view is found and then engage appropriately with the other stakeholders. That's the first point. I think the second point, Doga, is that in the previous session, and I think Thierry and Stefan also touched on it a little bit, is that one of the challenges we're facing for those of us that are lucky enough to be employed is that when we change jobs, a lot of us cash in those pensions, unfortunately. We do not preserve those credits in our pension for various reasons. And I think South Africa has tried to move towards a compulsory preservation, and I think there was a 2 and 4 the last time I checked. But these are some of the difficult conversations, unfortunately, we ought to have to ensure that we don't find ourselves in this position like the one you just highlighted. That we meaningfully engage for the benefit and for the betterment of those people that we serve in retirement. And yes, from the previous speaker, is that as well, and which point I agree with, is that the unfortunate thing is that to a large extent we have now moved into a new regime of defined contribution funds, where the risks have been passed on to you as a saver. And that puts the burden of making those hard decisions onto yourself as opposed to the employer, the sponsor. And financial literacy, unfortunately, is one big thing that we keep talking about, but my experience is that we are practicing. Quite frankly, it's scary what people know about money, but each one of us deal with money on a daily basis. But how we deal with money and how we save or use money is completely different. It's different from people to people, and that's in my view part of the problem. But I said I'm not an expert. I just thought I should share some of those points. Let me hand over to, I don't know who wants to contribute to that point. Question really is, one of the biggest costs for post-retirement is medical. You probably won't relate to that as yet, but I can, because I'm getting close to that. And it's actually that one of the biggest costs in your basket when you're 60 plus. Unfortunately, the body has just taken too much toll in life, and you will have medical bills that move up and down, and sometimes very huge. And Tioni said in Namibia we don't have stats on the appropriate replacement ratio in terms of facts. You said you estimated maybe it's even around 20% or so. Already, Doug, you are not starting with 75 or 76. You might actually be starting at way below that, which even compounding the problem. Do you want to venture on what is to be done around that problem? Medical costs being too high at retirement, while you are already faced with potentially a lower rate of replacement for your income. And everyone, please, Robert, you are also more than welcome, as well as Stefan, to kick in. We got 7 minutes.
I'll make a brief point. as an outsider. So the solution to the problem, which is essentially not having enough money, is either contributing more or generating higher returns on your investments. Those are the two options. Contributing more can be a challenge. I think education definitely has a role to play there, contribute and preserve. But you can only push it so far because people don't necessarily earn enough. And can actually have adverse consequences, seeing as unemployment is already so high, and you don't want to make labor unaffordable. I think a solution could be having fewer restrictions on funds in terms of how they're allowed to invest. My understanding is that the limits are quite restrictive. And I think funds can generate much higher returns if they were to be allowed to invest more offshore, for example. And sort of keeping money in Namibia to grow the local economy is sort of a short-sighted view when you can actually end up with members of retirement funds being much wealthier because they have large offshore exposure. So as an industry, I think that's something that you can lobby for with government. That would make a big difference.
Thank you.
Yeah, so I think Stefan stole my points, but I think I think it's really not it's not a different problem. I think medical inflation definitely is higher than normal inflation, but definitely I think the point just in terms of growing your savings. I think that net replacement ratio. So I mean different firms have a different way of calculating it, but essentially they do take medical inflation into account. So they basically just try to work out someone that's retired, and I think Reynald he made a very good point to say that there's a lot of costs that you probably have when you're working that you won't probably have when you retire, because as you obviously age, you're not going to travel as much, so you might not spend as much maybe on petrol. You might not. So there's a lot of things that they do take into account when they actually do it. But ultimately, it's really about contributing more and also having investment returns. And I think one of the things. So I didn't include the slide in this presentation, but was just to show you the power of compounding. So so given someone is able to have a job and be employed, if they can say invested, like if you take a 25-year-old who starts, let's just say someone is employed from the age of 25, and they've invested until the retirement age of 60, and let's just say inflation is maybe 5%, and his real return is 5, so in other words, he's growing at 10%. So after all those years, if he retires, 91, if he contributes 1,000 every month, 91% of his fund value will come from the investment return, and only about the rest will come from the contribution. So time invested in the market without taking it out and preserving are very powerful. And I think one of the challenges I think with the retirement fund industry is that you traditionally had a defined benefit fund that was based on it's a formula, but ultimately there's an accrual factor how long you've been employed by the company. Because in the past you'd stay 20, 25 years in one company, but the world we're living in today, people change jobs, more regularly. And I think a question is, that ability to cash in. I mean, the numbers are sort of hard in the Namibian context because we don't sort of record it across all the different funds. But I can imagine, preservation is definitely something we really need to think about. But yeah, so I don't know if it will sort of give you the answer that you're looking for. But I think some of the things we spoke about today, I think definitely speak to what you're saying in terms of people being able to retire with financial dignity.
Great. Is that the question? There's another question here. And that will be our last question, and then we'll close down.
Thank you. Thank you very much. My name is Franz. I must say, really, I enjoyed the presentation. I just somehow didn't hear much regarding to, Stephen made reference to blockchain. I see blockchain as something that is fundamentally it's going to transform the ecosystem of saving. Offer different market, participate in the market of technology with new offering. Because I feel like in my reading of technology, blockchain would fundamentally transform society in the domain of investment and saving. And I didn't really hear you speak to that phenomenon that much. So at least we understand how you direct the investment industry in the country. Thank you.
Thank you, Franz. Sadu, I think one thing you should do next year is that to make sure that Franz is part of the panelists. Surely I've got a lot to contribute in that space as well, as you can tell from his questions. We got literally just over a minute by the only time that has been allocated to us. Unfortunately, we haven't spoken much about blockchain and what it offers. What I can assure you is that it's something that our industry at least pay a lot of attention to, and the blockchain is a platform itself. They've got a lot of usage, especially with artificial intelligence and all that, to be able to help us to get to a decision in the way that we can allocate capital to generate those inflation-beating returns. But perhaps just in the interest of time, I'll give each one of you literally seconds to try and see if you can answer that question, but also disclose so that you can hand over the mic to the moderator. Sorry, to the MC.
All right, sure. So yeah, I think sort of my view is, when you look at investments, you always want to be on the right side of trends. And when we do our bottom-up stock analysis, we incorporate all the technological change. So even if you look at companies, the way they operate today isn't the way that many of them operated. So that is something we incorporate. Blockchain is not an investment in and of itself. It's sort of a technology, right? And it's going to impact how different industries work, and sort of we just make sure that how does it impact the investment case and be on the right trend. So I think that's sort of my response to that. And then also, just in closing, I'd like to thank Arfin and all the delegates for not leaving, hearing our voices, and also my fellow delegates. Thank you so much.
Great. Robin?
Yeah, so I think the two things that from my side, I think the opportunities that technology like blockchain offer are obviously transparency, time, as well as hopefully over the sort of medium term is obviously reduce costs. And I mean, if you can reduce costs for members as well, that will be largely beneficial. I do think sort of one slight downside to that is obviously the pension fund space is very highly regulated, and regulation tends to be very slow moving and backward looking. And so I think that might be sort of the one drag on that. But yeah, that's sort of it from my side.
Thanks, Robert. Stephen?
I would just briefly raise the point that it's important to distinguish between blockchain and cryptocurrencies. So as Yeni mentioned, we look at blockchain quite closely. There are various operational and system advantages that different businesses can enjoy through the implementation of the technology, but that's quite different to speculating and buying coins, right, digital coins. Personally, I believe, sure, there's a future for cryptocurrencies, but there are just so many, there are no valuation anchors. How do you pick one? Which one will win? And then to put retirement savings into that kind of investment, in my view, that's a bit of a gamble. That's not to say that you can't make a lot of money with it, but that in itself isn't a good enough reason, in my view.
Thank you, gentlemen. Thank you once more to the audience for your patience and listening to us. And we handing over the mic.